All right, everyone, welcome back to the channel, your number one source for income-oriented investing. I have not one, but two special guests today from SVOL ETFs. I have Larry Kim and also Shailesh Gupta, returning champion. This is the third time now Shailesh is back on the channel. So I really appreciate your time, by the way. And just for the record, I literally sent you guys an email. You want to come back on the channel, talk about SVOL and this? And you guys said, sure, what time? That's literally how this came about. So I really appreciate it, guys. I know Shailesh, you're feeling a little bit under the weather, so we appreciate it even more. How's it going, guys? How's everything?
Going is good, and it's always fun to talk about a success story, which is easy to talk about the past success, but we will also touch upon, what to see in the future and where one can make money going forward without taking too much risk.
Yes, yeah, for sure. And as you know, Shailesh, my channel is all about income-oriented investing, and SVOL, which we're going to talk about primarily, is one of the favorites. One of the favorites in the community. It's been doing really, really well, performance-wise, stability-wise, income-wise as well. And I have noticed a little bit of changes in SVOL. So I've been getting some questions from the audience, as SVOL changed their strategy a bit because the holdings are a bit different. So let's get into talking about that right away. So in case my audience doesn't know, SVOL is the Simplified Volatility Premium ETF, which we talked about several times on the channel. Basically, what you do is you short the VIX to get a premium. You also buy a protective call, a very big out of the money call option to protect in case the VIX spikes. So if you look at the holdings, and let's just go right away to the holdings here. So here are the VIX shorts, basically. What I was talking about, here's the protective call at 60 in case the VIX hits 60, and then most of the rest are in US Treasury. But I've noticed that there's other stuff as well. I see a nice big position in AGGH, a little position in BUCK, which is kind of like your cash enhanced ETF, and a little bit in CYA. So my first question to you guys is, can you talk a little bit about SVOL? Have you updated the strategy? Have you switched the strategy a little bit? What's new with SVOL?
Right. So when we started SVOL, the mandate has always been to get the core exposure by shorting VIX.
Yeah.
However, not leave the cash uninvested, but invest in fixed income securities. And when we started SVOL, the 2-year Treasury yield was 0.1%, like 10 basis points are pretty close to nothing. So it wasn't that much of a factor. But now the interest rates are north of 5%. So it is very, very important to take advantage of that, yield component from the market. That cash should continuously do its work, and it should, if you invest in the right fixed income securities, they can also act as a buffer to a big spike kind of environment, which is a principal risk in the strategy.
Okay, so this stuff here, am I correct to say that it's mostly treasuries here?
That is correct. And there are treasury bills, and also there are short-term inflation securities.
Okay, and here you have the protective call. Here you have the VIX shorting, very easy. But I did notice that you added pretty significant position to AGGH, which is the Simplified Aggregate Bond ETF, which is if you look at what it is, it's basically to try to give you bond exposure with enhanced yield. I always get excited when I see enhanced yield via structural income opportunities such as more efficient curve positioning and defined risk option writing. Can you explain this ETF and what it does?
Right. So like from a 30,000 feet point of view, like a traditional balanced portfolio typically has 60-40, 60% equities, 40% bonds, which is traditionally known to have a very balanced risk. One risk is diversifying the other at the same time. In a flight to quality situation, when equity market is coming down, bonds are making money. So it has been a very successful portfolio over decades. So one can think that probably, on an average, a 60-40 portfolio would be a very, very, stable portfolio. On that account, half of that 40% is going into AGGH. AGGH is a core bond substitute. And when we take a beta risk, like in the equity market, you have covered calls, or in the fixed income market, if you are investing in bonds, why not enhance the yield on that part of the bonds? So the bonds are making 5-6%, but by income enhancement and choosing the securities wisely, like these inflation securities, one can get a yield of north of 10%. So this is what is happening, where the cash is getting invested in the most risk adjusted, as well as balancing the bad scenarios that could potentially happen in a COVID kind of a scenario.
Okay, and I see a bunch of stuff here. I recognize some of the ETFs, not all of them. I see that they're mostly, they look like fixed income, some boring long-term fixed income stuff. I don't know what TII is here, but I also see that you're writing calls on LQD, AGG. So how does AGGH make money? I mean, because the
Right.
yield is pretty high, right? The yield is about 11% right now. So
Right.
can
So
you just explain it?
right, the way to think about AGGH is it's a core bond fund. We buy the best bonds per unit of risk.
Okay.
And when we have a risk position, you always have a view that if the price goes to Y, it increases by 2-3%, that you would want to sell it. If you already have that decision in mind, you can sell options at that strike. So effectively, if it reaches the price target, then well and good. And even if it doesn't, you collect that extra income. Similarly, you would want to own or increase position in certain bonds at a certain price, which it's not there at your target price, but you can sell options, sell puts at that price. So if effectively selling calls and puts,
Right.
around the risk position, these are all treasury related risk positions. So the low risk securities, you can, I will like to share my chart and show that while the VIX is low, the VIX of the interest rate market is quite high. So
Yeah, go
selling
ahead.
options in the fixed income market is very, very attractive right now. And this is also related to the video that you recently, posted, or was it recent, or I found it very intriguing that, fixed income based income enhanced strategies are getting popularity in Canada per se. And I'm very impressed that, Canadian income investing seem to be leading the charge, on that account. So,
Yeah, who would have thought, right? Covered calls and options on boring long-term US treasuries. But what you said is what I've been hearing is that now that the volatility is actually going up on the fixed income, and I think this is what you're showing here, right? This is,
right.
go ahead
So the
and
white
explain the
line
graph.
is the very popular VIX index. And when VIX is high, you can get more income. When the VIX is low, you don't get enough income by
Right.
selling calls on equities. However, the green line is the VIX of the interest rate market. And you see that it is trading, above average as compared to historical levels, while the VIX is close to on the low side. As you would
Uh-huh.
have noticed, many investors are not happy with not getting enough income by selling calls in the equity market, but fixed income is giving a very, very healthy, option premium. So, effectively choosing between the green line and the white line, it's not just about the volatility, but also think about the macroeconomic environment. What is a better beta? Is it equities or is it bonds? With the potential recession around the corner, probably bonds would be a better beta than equities. So if you have the bonds as a beta and the interest rates are high side of the range, so you are getting double benefit. So
Yeah.
effectively, historically, if you get 10% from a covered call, equity income strategy, you can get the same thing from the bonds. So why take stock market risk when you can achieve the same, level of income through the bonds? And that is what being done in AGGH effectively.
Yeah, so translation, the volatility on interest rates or on fixed income is higher than equities right now. So you're saying why take, and it has less risk. So if you could get that yield with the fixed income, plus rates are maybe at the highest, and if they go down, then those ETFs are going to go up in value. It's a win-win. So that's actually the argument I've been hearing a lot of the Canadian providers and why they launched the ETFs, because not only can you make income with the covered calls a lot easier now with the higher volatility, but you even have potential for upside. And overall, I mean, these are less risky assets than equity. So
Well,
hopefully that translation was good, but I
I
think
mean,
that's
I should qualify, everything is not hunky-dory in the sense that fixed income market interest rate changes can be quite
Mhm.
vicious. Suddenly it was 4%. Currently, 10-year treasury is close to 4%, and a month back it was 5%. So the interest rate market can be quite whippy. So selling options can be challenging. And the way to mitigate is that you can't just have one kind of covered call strategy in the fixed income, but you should have a much more diversified portfolio across various parts of the yield curve and various strikes.
Uh-huh.
So that's why I was very impressed by the video that there are many covered call strategies with different nuances of different strikes
Yeah.
at different maturities.
Different durations. Yeah, yeah, for
Right.
sure.
So, and
Well,
that duration is a very important concept for the fixed income market. And just to get your sense, you can get more yield by having more duration. You have more duration, you have more risk, so you can
yeah.
get more premium. So it is very important to get the right, mix. So, on an average, we should have 1/3 in the long end and 1/3 in the medium sector and 1/3 in the short end sector. But on an average, the duration of the US fixed income market is around 6 years. And that should be the average duration of the portfolio, as well. Either you achieve through a 1/3, 1/3, 1/3 kind of a
Mm-hmm.
scenario, or you can have an active manager like me picking the right bonds and the right volatilities as being done for AGGH.
Very interesting. Thanks so much for sharing that information. So yeah, AGGH, I actually just compared it to TLTW, which is very, very popular. They just write covered calls on TLT, and AGGH is beating it in terms of total
Right.
returns, probably for the reasons you say. It's more diversified, there's a bit more active management. So yeah, pretty cool ETF, about 10, 11% yield here. And the distributions have been pretty stable at 20 cents as well, which is pretty good. So okay, perfect. So let's just go back to SVOL real quick here, because that is really the community favorite. So correct me if I'm wrong here. The addition of AGGH, it's really to manage or get the most out of the cash in the portfolio while still doing that core strategy of shorting the VIX, buying a protective call option just in case it spikes like crazy. Do I have that right?
Yeah, absolutely.
Okay.
So if just from a theoretical point of view, all the cash can get invested in fixed income securities,
Yeah.
and if they do the optimal level of option selling, the cash should be able to generate 11%, and that is what AGH is demonstrating. So the VIX one doesn't really need to take too much risk in this environment. If you're getting 11% from fixed income, get another 6, 7, 8% from VIX instead of, say 15, 20% when we
Mm-hmm.
started this product. So we don't have to take too much risk on the VIX side. And effectively, given the lower amount of VIX, you don't have to spend that much money on the protective options. All that put together combined, it makes it a lot more robust, portfolio that you can see in even SVOL chart. If you dissect, first 1/3 of its life cycle to the medium last year to this year, you
Yeah.
see the volatility is reducing, and the risk is getting reduced, and the returns are getting enhanced, so to say. So it's a function of
Yeah,
I can, yeah, I can show a
it's
total return chart if you know.
And Adriano, the AGGH also serves a secondary function, and that is that the fixed income can serve also as some type of tail hedge in case of a violent VIX.
right, because VIX has to do with equities and AGGH has to do with fixed income, right? So it's
Right.
not
In
okay.
fact,
Yeah,
we were just doing a analysis with Larry that given that VIX futures are now more in the 5-6 months kind of a maturity rather than first 1 and 2. So effectively, if you think of a static portfolio with one contract for $100,000, first contract could lose as much as 50%, during a COVID kind of environment.
yeah,
However, the sixth
spike.
contract would lose less than 15%. So, your risk is less than 1/3. And if you can, get half the yield with 1/3 of the risk, on a risk adjusted basis, that's a good deal. And, even if you say, suppose a COVID happens and you lose 15% on futures, the options probably make 10% and the bonds make 5%. So effectively, portfolio, I'm quite confident that if COVID happens in next month or two, the portfolio will be pretty much immune to that kind of a
That's
risk.
fantastic. It just I like what I'm hearing. I just hear the evolution and SVOL just becoming more safer and more stable. And I've been seeing a lot of comments from the community. I love SVOL. It's so stable. It's just a consistent source of like 15% yield. It's awesome. So real quick, guys, let's talk about the distributions, which is very important, obviously. They've been 32 cents for a while. It was reduced a little bit to 30 cents. Any reason why? Is that because the VIX is so low? Do you have
Yeah,
any
I mean,
comments on that?
the idea for this product was around 15%
Yeah,
yield. When the yield started getting close to 20%, then should we increase the risk or reduce the distribution was the decision at that time. And we found that just reducing the distribution a little bit, we can that is a much more of a sustainable level that we think. And so that's why we have stabilized to that level. And I can see your next question over there on that chart is regarding return of capital,
yes,
right? So now this is an accounting thing that P&L on the futures, there are various kinds of tax treatment, 60/40 and so on and so forth. How much is the capital gains and how, I'm not a tax expert, but the way I see it, if the strategy is making 20% and the distribution is 15%, then your capital gain is 5%. And if the taxman qualifies part of the 15% also as income of only 10% and 5% of another capital gain, so net on an after-tax basis, you're better off most of your gains getting classified on the capital side rather than on the income side. So I think that is what is happening. And I'm not a tax expert, and I have no idea how the taxman
yeah,
is calculating this. My job is to design the portfolio to give more than 15% yield with less than market risk. And at least in the current environment, we are confident that we can do that, especially, the boost from AGGH. If you're getting almost sort of, low risk 11% yield, then, 15% should be very, very achievable.
yeah. I get this is a consistent question I get no matter how many. I think I made 2 videos specifically on rock and how it's not necessarily just your own money coming back to you. People are very confused by this. Like you said, the best way to look at it, it's just an accounting thing. It's not that the fund is giving you your own money back or out distributing. So maybe Larry, you could help with this. The main question or the main concern people have, and I'll just ask it outright, the fund is not paying out more than it earns. Maybe in some, maybe I'll let you explain.
Yeah. Well, a quick way to look at it is look at the whole year.
Yes.
So year to date, the fund price is up around 4%, right? Despite the fact that we've paid out, I don't know, something like $3.50 worth of distributions over the course of the year. So even though the distributions have been paid out, the share price is slightly up. So in other words, we have distributed less than the fund has actually earned. So, that's the goal with the distributions, is to sort of match the return of the fund over a long period of time. So there may be some months, suppose like VIX just steadily goes up over the next month.
Yeah.
It's possible for VIX, for SVOL to have a negative total return, but we're still going to be paying out the distribution because that's what we believe it's going to work out to in the long term. And so far, we've been pretty successful at that.
Yeah, I definitely see that. Okay, so yeah.
Philosophically speaking, people think of yield as return, but in
I know it's not.
evaluating an investment, one should start with total return. The
Yes.
total return would have some income and some capital appreciation, but sometimes it could have more income and negative capital appreciation in an environment when the VIX is, going up. So, the yield can be a very tricky concept in the sense that what is yield? Yield is sort of like expected return if the market remains unchanged. And the portfolio is designed in such a way that if the equity market and the fixed income market remains unchanged, the portfolio, makes a return of around 15%, which is the definition of yield. But as you know, markets almost never remain unchanged, and sometimes they will have capital gains and sometimes they will have capital losses.
Yeah, for sure. Yield is not the same thing as return. And I have to say, guys, the total return of SVOL hasn't been nothing short of extremely spectacular and mind-blowing to me. It's beating almost every, I think even it is beating every equity covered call strategy out there. I mean, I'll just pull up real quick SVOL versus JEPI, and you see which is the most popular one, and it's not even close. The total return is not even close. So, I'm talking to my audience here, guys. There's nothing to be afraid of when it comes to ROC. It's completely normal, and it's not it's not because the fund manager is giving your own money back or paying out more than it earns. It's just simple accounting, like Sailesh says. So
on that total return fund, let me share my screen.
Go for
it.
it.
Show you my favorite chart.
You probably have better screens than me, so go ahead. You're more than welcome.
Good to be be able to spend $2,000 per month on Bloomberg. Someone can fancy,
right.
Fancy chart. So this is stock market in the red, and maybe a little smaller picture is a better one to see. You see, I will also add I won't name any other competitor fund, but you can see that since the inception of SVOL, the covered call strategies on an annual basis have been pretty close to the growth in the equity market, which is reasonable. Equity markets are sideways, options income is enhancing yield, but often sometimes when the equity markets are jumping up from the lows, options are not able to,
Yeah, you don't capture the upside. Yeah, that's
correct. So like covered calls have lower risk in the equity market. So this is kind of normal. What is abnormal is in SVOL that we have seen that in the first few months, it was pretty much tracking the market. And last year, it kind of pulled away, and this year has been spectacular. So you can see the risk is lower and the return is higher. And this is because of the environment. Now the interest rates are a lot higher. We don't have to rely solely on VIX to generate, all the yield. So, the balanced portfolio, this is a reflection of a balanced portfolio, which can, generate the target yield or the distributed yield without taking too much, downside risk.
Yeah.
As you see, in March, SVOL had a lot of VIX exposure, but still less than the market. And subsequently, we have reduced it further. So we continuously keep looking at ways to improve the portfolio, improve the returns, reduce the risk, any which way we can, find a way to do it. That's what we do.
The last sentence you said, Shailesh, that's exactly what I want to hear from my portfolio manager. So I have to say, I mean, congratulations, guys. I mean, you're just destroying with this ETF. It's definitely a community favorite. I own myself about $60,000 or $70,000 worth of it. I absolutely love SVOL. It's just a consistent cash cow, and the numbers really speak for itself, right? So.
On that account, let me show talk about this chart as well. Sorry.
Sorry, go ahead. I stopped it prematurely then. Sure, go ahead. I
So
could talk to you guys all day, by the way, and there's no time limit or anything. So
on an average, as we
yeah,
saw, that covered call strategies have a
yeah.
little bit of a drag because they have a little bit of lower risk. But in fixed income market, if you choose the strikes correctly, there's so much money made by selling options in the fixed income market that covered call like strategy AGGH is actually outperforming the bond market. So bond market year to date has made 2.4%, while the fixed income has made 5.4%.
So this is AGGH.
Correct.
That's
So
outperforming just a traditional bond stuff, right?
right. So on an average, over long horizons, covered calls probably would have a lower return, if you have algorithmic selling options 1 or 2% out of the money. But, one can, the way to improve the returns of a covered call strategy is that after a dip, you should switch to the regular beta without the option selling, right? So one can actually do that physically in the interest rate market, choosing the good bonds and the best bonds, and choosing the strikes that you said, when the interest rates are trading at 5%, why
Yeah.
should you sell an option at 4.75% yield? I should sell at 4% yield, right? So I can be much more dynamic at what strikes, what maturity, which products, the option that I can sell, and actually we can outperform the market.
Yeah. So this is I mean, this goes with all your strategies. These are all actively managed strategies. They're not passively systematic strategies, which is the strategy I prefer when it comes to options. So
I mean, like in
obviously,
fixed income market, my advice would be that if you are choosing systematic strategies, then you should have a very well diversified portfolio against short, medium term, long term, various strikes, various maturities, this, that. Or, pay a little bit extra and get an active manager to do it for you.
Fair enough. Fair enough. So yeah, I mean, congratulations on the success, guys. Do you mind if I stop sharing the screen, Shaila, or you have other stuff to
Go
show?
ahead. Yeah.
Okay. So yeah, I think that's pretty good. It pretty much answers most of the questions on AGGH and SVOL. One last question about SVOL. I noticed that the fees 1.16. I think it was a bit, wasn't it 0.66 before? Can you just explain that? Is it because of a waiver went away or something, or?
No, the management fees has been constant at 0.5%, as you saw.
Yeah. Yeah.
And this is again one accounting anomaly that the way accounting does is, we are allowed to borrow against the T-bills for short-term cash management purposes. The way the accountants classify is that the borrowing gets counted as an expense, but the income is not. So only that borrowing and lending activity gets charged and optically looks like expenses, but actually it is not. So the expenses remain close to 50 to 60%, 50 to 60 basis point, as you can see in this table. Those other expenses are mostly the borrowing expenses.
Right. So nothing to
Unfortunately,
be scared about.
we're not allowed to count the income that the borrowing resulted in some income, but we're not allowed to offset the borrowing cost with the income. So it's only showing one side of the equation.
Yeah. Yeah. And the more I speak to fund managers in Canada and the US, the more I learn of how insanely regulated and so many rules and accounting rules. So this is why, I like to talk to you guys, and it's nothing to be scared of. And of course, total returns are net of all fees, right, guys? So that's the most important part in SVOL.
Right. I mean, this is even extreme that if your cash is invested in T-bills,
Yeah.
and you are borrowing money so that you don't, for a day or two, so that you don't have to incur transaction costs. So your income is getting classified in the distribution part, where the expenses are showing up at expenses.
Okay, I
Net
understand
net,
now.
they are kind of a wash, but it just shows up as other expenses.
Okay, just accounting then, nothing to be concerned about, basically. Yeah. Okay, cool. So appreciate your time, guys. I just want to talk about two more ETFs that are income oriented that I really like
One
as
more
well.
thing,
Sure.
this expense is from the balance sheet of the fiscal year ended June of last year.
Okay.
Anyway dated, it is not current. So, this year expenses will start showing up after June of this year.
Yeah.
I know
Okay.
this is just optical, but still we are avoiding, from borrowing from that market. It just, optically looks the expenses bad.
Sounds good. Sounds good. So, all right, we covered SVOL, AGGH. Another one I have to that I really like and that I've been keeping my eye on is HIGH, the Simplify Enhanced Income ETF, which has been just the epitome of stability with an approximate 9 to 10% yield. You could see here that it started at 25, now it's at 24.57. It's barely moving, but it's pumping out amazing monthly income, which is obviously a positive return. So HIGH seems to be a bit similar to SVOL, where you have a lot of T-bills and stuff to really hold cash with to make some income. And by the way, it's been growing very rapidly. The yield's about 10%. The fee is very low at 51 basis points. Total return has been pretty solid as well. Let's just look at the holdings real quick. So I see a bunch of short dated call or put spreads. That seems to be the strategy of the ETF. And I see them on all kinds of stuff, whether it's the S&P 500, whether it's TLT, and then of course, most of the cash is going to be in T-bills. So can you just give me a quick summary of how this ETF works, why it's been so extremely stable as well?
Right. So, we discuss about an environment where the T-bills themselves, gives you 5-6%.
Yeah.
And on top of that, if we can opportunistically find, pockets of the market where, single name equities, if there is a speculative demand to buy options on them, then that gives you an opportunity to, generate some income. And the TLT options take advantage of the high interest rate volatility, that we discussed. So if you're getting 5-6% of the base of the cake, and through these options you get additional icing on the cake, makes it a healthy 9-10% yield without any beta risk. SVOL has equity market beta risk, AGGH has bond market interest rate sensitivity, but some investors don't want any kind of sensitivity. That this product is ideal for them.
So would you say this is kind of like, it's similar to SVOL, but it has even less risk?
SVOL has the VIX risk
Yes.
and the interest rate risk, which are balancing each other.
Okay.
Right. So together, they
Yes.
give you a balanced portfolio kind of profile, giving you 15%. And AGGH doesn't have any kind of beta risk. It is very opportunistic, tactical, run through algorithm, or very well tested historical back tests. And so if you don't want beta risk, just want cash to be efficiently invested, and when the portfolio manager sees opportunities to pick up income without picking up too much risk, and that's what you can get in this portfolio.
Yeah. So Larry, I think you're talking, but you're on mute.
So I was going to say that whenever you are sold an option, right, you have taken on some degree of risk, right?
Yes.
So one of the ways that HIGH seeks to balance out that risk is you'll notice that it is sold S&P put options, but it is kind of balanced that out by selling individual equity call options.
Okay.
Right.
Yeah. So you see that here, and then I see some equity options here on CVS, which is the pharmacy company, and
Rivian. So one of the questions we get is, well, if you've sold S&P 500 put options, why don't you just balance out the risk by selling some S&P 500 call options as well? But the problem is that selling calls is such a popular strategy, because of all these covered call funds, that there's not a whole lot of premiums that are available by selling S&P calls.
Plus the VIX is low now.
Right. So one way to pick up some more attractive premiums is by selling the call options on individual equities, right? But then in order to avoid that idiosyncratic risk, you have to diversify it amongst a group of individual
you
equities.
would notice the broad theme in our option selling is we are one way or the other trying to take advantage of the demand supply imbalance. And in the equity market, there is demand to sell index options with a covered call strategy. So on an average, one is better off not doing that, but by selling calls on the single name equities, which could potentially have speculative demand. And on the put side, there could be insurance related demand for buying S&P puts. So when the demand supply balance is in your favor, that provides a good tailwind to a strategy.
The common theme that I'm hearing from you, Shailesh, all the time, you're taking advantage of imbalances in the market. Honestly, I'm very, very impressed with these. They're very, very, very unique. I'll say that right off the bat. And myself personally, I've mentioned this in previous videos, I think high could be a really nice alternative to put some cash to work. If you have some cash, some short-term cash, that's just my opinion. I know it's not super safe like your buck ETF, which is really designed for cash, but just looking at this stock chart since October 2022, it's barely moved. You might be asking, okay, well, how is this a good investment? Well, it's giving you monthly income of about 9% yield. So it's a very cool, very good investment that's relatively safe. So thanks again, guys. And the last ETF I want to talk about is MAXI. I love MAXI. It's the one I owned. Obviously, it's been kicking ass this year because Bitcoin's been going up really, really high. But the genius of it, why I really, really love it, is because how can we squeeze income out of Bitcoin? You guys don't have in Canada, we have a spot Bitcoin ETF for years now, but you guys don't have one yet. There's speculation around it. That's why it's been going up. But what you guys do here, and correct me at any time, is you're getting exposure to Bitcoin using futures. So it's not spot Bitcoin, it's really futures, which more or less tracks the price of Bitcoin, which is, you could see that right here. But simultaneously, you're kind of doing what high does, or the strategy that high does. You're selling short dated put or call spreads. You actually see them here to generate more income, right? So tell me the premise behind this ETF and who's the genius who came up with this thing?
Well, I'll let Larry elaborate on the genius part, but this basically, in high, as we discussed, there is no underlying beta. That beta, some people, there are plenty of products with equity beta, there are plenty of products with the bond beta, we have AGGH and the SVOL, various diversification, so on and so forth. However, this is sort of an high with the Bitcoin beta is what.
Yeah, obviously the risk is Bitcoin, right?
Right. So, you have cash invested in T-bills and you have option strategies. If you remove the Bitcoin, this strategy is very much like high.
That's
and
what
now,
I thought.
Since you have cash available, which can be used as margin for the future, so you can pretty much choose any beta that you like. And MAXI, the Bitcoin beta, is something, income enhanced Bitcoin strategy is not available, and might as well, since high is doing so well, that strategy is doing so well, that can combine with the Bitcoin to give an income enhanced Bitcoin exposure.
Yeah, which essentially what you're saying here in the description is you have Bitcoin exposure, but you're kind of you're having a little cushion or a little bit of downside protection with the strategy that high does, giving you that income. So yes, Bitcoin could go up and down, and this ETF will go up and down with what Bitcoin is doing, but you'll get that nice yield, that monthly income by doing those very low risk short dated call or
So
put
that's
spreads, right?
the advantage of an income strategy. When you have a tailwind, then even if there's some turbulence in the market, at least there is some cushion.
Yeah, there's some cushion. Exactly. I have to say this is very smart because it's not a covered call. In Canada, we have a covered call Bitcoin ETF, but when Bitcoin goes up 6%, the covered call ETF will go up 3 or 4% because you're giving up Bitcoin exposure. But this one, what I've noticed is it really is a lot closer to, you're capturing more of that upside. You're not really limiting. Of course, it's not going to be perfect because it's futures. I understand that. But do I have it right? Am I
Yeah,
saying the right?
there's no when you sold call options, you've effectively capped your gains,
Right.
right, to the strike price of the call. But since we're not actually selling options on Bitcoin, there is no theoretical, upside limit.
I love that. And it's been performing really, really well. I actually put Maxi next to the covered call Bitcoin ETF, and that's the behavior I've been seeing. There's much more upside captured. And there's also that cushion, but instead of using that doing that cushion with selling covered calls on Bitcoin, you're doing what you do in high
Yeah, I
risk,
mean
right?
the thinking here is that
Mhm.
people that want to own Bitcoin
Yeah.
are, generally have a high risk tolerance. They kind of know what they're getting into and they want exposure to Bitcoin,
Yeah.
right? So if we sold away, much of the upside, there wouldn't be, that much point to it.
Yeah, yeah. Well, people, my followers know I got about 40, 50K in Maxi. I have it on drip. I'm just dripping away. And I'm not going to talk about the expenses anymore. It's accounting, I'm assuming. Again, that's why you see a big total expense of 11.18, but the management fee is 85 basis points, which is actually less than the Canadian one, to be honest with you. And here's my question that I'm really excited about. Let's say, Larry, or sorry, let's say Bitcoin just keeps going up and up and up, 60,000, 70,000, 80,000. Obviously, the net asset value is going to keep going up in this fund. Will that mean that it's very possible that the distributions will go up as well because there's more value or more cash in the portfolio, or it doesn't really work that way and you think it's always going to be about 15 cents? I don't know if my question makes sense.
I think suppose like in an extreme case, suppose Bitcoin doubles. So
Yes.
you have, more cash available to invest in a high kind of a strategy, right? So per share, I'm pretty sure the distribution will increase, in
I love
that
that.
case.
And it makes sense, obviously, to me. So awesome. Awesome. Guys, we've been together almost an hour. I really appreciate your time. It's been awesome. I mean, these are some of the community favorites, especially SVOL, but now we have AGGH in case someone wants to add some bond exposure, some pure fixed income exposure to their portfolio in a more efficient way.
It's up to investors. They want cash like investment. You have 9% yield from high. You want a bond kind of investment, you can get 11% on AGGH.
Mhm.
If you really want some extra juice, best of all the world, then you have SVOL with more than 15% yield.
Perfect. Well, listen, guys, I'm looking forward to more ETFs. You obviously have some very, very good ideas, very unique ideas, especially for us income investors. And the space is getting more crowded, but I have to say, I've seen nothing like these. Very, very unique. So again, unless there's something you guys want to add, Larry or Shailesh, I'm good to wrap up here.
Thanks, Adriano. It's our pleasure. Anytime.
Well, we'll keep in touch and we'll do this again soon. Take care, guys. If I don't
All
see
right.
you,
Thank
have
you.
a happy holidays, Merry Christmas, Happy New Year, the whole thing.
You too.
To
Take
all the
care.
viewers as well, thank you. Happy holidays.
Yeah, you too.